Hi, I'm Barry Clark. Welcome to the Mortgage and Property Podcast, brought to you by Mortgage Monster. Now sit back, relax and get ready for top tips, tricks and advice to help you with all of your mortgage and property needs. Welcome back to the Mortgage and Property Podcast. Today I'm joined by one of our brokers here at Mortgage Monster, Grant Daines. Grant, how you doing today, buddy? You all right?
Yeah, not bad, mate. Busy, but apart from that, all good.
Believe it or not, Grant is actually the fittest member of our office, and he does marathons and long bike rides and all that other stuff.
I don't think it's so fit. I do long things like that, but I struggle with them. I get to the end. That's all that matters, I guess.
Just got to take those stabilisers off for the next big race.
Yeah.
I've asked Grant to have a chat with us today about the future of financial landscape. As a broker, just to kind of really just have a chat about it. It's nicer just to talk things through with someone rather than just hearing my voice all the time. I really just want to have a bit of a chat to you about what's going to happen. Are you prepared for the, whatever we're going to call it, the recession, the financial crash, Armageddon, depending on what, how it's actually looking landscape. I mean, I suppose you have to be a bit careful about what we say because it might come back and kind of bite us in the backside. We were kind of all laughing and joking at coronavirus at one point when it very first started. And that quickly escalated.
Absolutely.
So, we won't kind of play it down too much as to what's going to happen. But I mean, Grant, well, first of all, hello and that sort of stuff. You're good?
I'm really good, mate. I'm really good.
All right. So tell us what you think is kind of, potentially what the future holds and what you're looking at yourself over the next kind of little while. What do you think is going to happen?
Well, I wouldn't go kind of down the Dad's Army, we're all doomed sort of route.
Armageddon, sandbags.
It's the end. But I think it's going to be... So I think it's going to be tough for everyone. And I think we're all going to... Yeah, I mean, we're there, but I think this is like the start of a prolonged period of tough time for everyone in the country. The energy crisis is something that's not going away. The cost of living crisis is getting worse and worse by the day. I mean, we just had the energy caps gone up by 80% real recently. Yep. So, it's going to be tough and people need to be prepared for it. And if they're not, they're going to get hit. They really are.
Yeah, it is. I mean, it's something which we haven't seen for a while. We've seen a very, very good, rates have been really, really low for a very long time, since kind of about 2009. So they've dropped down, been really, really low. We've not seen a time whereby mortgage rates, for example, have ever, started kind of going up, and people have been in kind of markets whereby, their payments are going to get more expensive next time they come to remortgage and so on. But first, let's go back as to kind of things like sort of like inflation and rates and that sort of stuff. So, I just want to talk about, why we're in the situation that we're in at the moment, so people just get a bit of a clearer understanding. So what's your thought on why inflation is where it is at the moment?
Well, we've got the big things that we know about, which are, again, I know I keep harping on about it, but we've got energy crisis, we've got the cost of living, we've got fuel, things are going up. That's going to raise inflation, multiple times, because there's the unseen demons that sit behind it. So, for instance, when we had the shortage of gas creates things for the farming industry, which then they have to knock that cost onto the consumer. So everything's going up because of these hidden costs.
That's the same with kind of crude oil and that sort of stuff. They're used to make plastics or packaging for transportation, for absolutely everything else. And the fact that it all adds on bit by bit.
And it all just keeps going up and up and up, and everything just keeps kind of compounding upon itself. I also don't think, a bit controversial, but I also don't think, given all the free money away that the government did way back when, helped, because we've spoke about this before, but it pushed up the cost of secondhand cars because all of a sudden everyone had a load of free money. A lot of people used it for the right reasons, some people didn't, and it just pushed up costs. Everything is now more expensive than it was before.
It seems to I've done a bit of research before we did the podcast, and potentially they say that we could see inflation. I think it's going to be higher than what it was previously. Could see inflation as high as 14%, which means that things are 14% more expensive than last year, which is absolutely crazy.
Yes, and when what we know, that the MCP, the biggest weapon they have to fight inflation, is the interest rates. So if we're all going to see inflation going up 14%, then interest rates are going to go up to try and fight that. So we're more likely to put the money in our bank accounts than
not spend it. That's exactly it. So basically, with the kind of base rate increase, and I think it's unfair. So, most inflation is caused by people spending, kind of buying too much. It's not necessarily caused by outside factors such as fuel, such as all these different bits and pieces which are causing it. So it's kind of like the government also almost have to squeeze people so physically hard and squeeze so they can hardly kind of, to almost an inch of their life. And then people then, make such a an overreaction to kind of stop spending. And that's when they think inflation is going to kind of fall. But it is kind of, they're being unfairly squeezed, I think, or are due to be unfairly squeezed.
They're not looking to make people's lives mildly annoying. They're going to try and make people uncomfortable, because when you're uncomfortable, that's when it's going to work. Yeah. If it's just an annoyance to you that you don't have the extra 50 quid for the McDonald's that week, that's just an annoyance. When you are really struggling, that's when you're going to stop spending your money and you're going to start saving it, and that's when inflation will start to come down the other side.
I think certainly from the friends family that we have, everyone's talking about it, whereas people weren't kind of talking about it before. Now it's on the front of everyone's mind. You cannot possibly open up a newspaper. You cannot turn on the you cannot possibly turn over anything at all without finding out about more things that are going, harsher things that are going on, about energy price caps increasing, about all rates going up, about everyone pushing their things up. Luckily unemployment's kind of still relatively low at the moment, but we're starting to see potentially more and more and more of people and businesses indeed getting squeezed.
Never in my life have I looked at something and tried to prepare for the future. So and this is honest truth. At the beginning of this year, I kind of, everything was, normal. You have your credit cards, you have your, various different bits and pieces of finance you have throughout your life. As it started to bite in, I thought to myself, when this gets to the winter months, this is going to really hurt. So I started to kill off things like my credit cards, tried to get them paid off, tried to get my, my store card paid off. And they have been now, because I know at the moment my electricity bill is 300 plus. When the gas bill kicks in and then we got that 80% kick up again, I could be looking at a utility bill, just a utility bill, about £700 a month. So if I'm not prepared for that, no one in their right mind can reach in their pocket and pull out 400 quid out of nowhere. I mean, some people may be able to.
Not every month.
But I can't, not 400 quid every month, month in, month out, and with no prospect of it coming down. So again, I prepared for that.
I mean, there is speak of it not lasting forever. There is speak of us going through, a bit of a turbulent time. Potentially, it could be, I know, somebody's saying kind of a couple of years or something like that, and we will get kind of a bit harder before it does get easier. And one of the things that we're kind of, we're asked all the time, what we're getting asked, probably I'd say on almost an hourly basis, not a daily basis on social media, is what a rate's going to do. And also, while we don't know, we've got a fairly kind of clear idea, but just to be aware that what you might find is that as an interest rate goes up, that normally has quite a serious knock-on effect in terms of what mortgage rates you can get. So I wouldn't say that they're directly kind of influenced, but they're not far off. Yeah,
I mean, doing the job we do, we obviously follow it as best we can. We don't have crystal balls, and we can't make
I mean, a crystal ball.
Yeah, a crystal ball. Yeah. We don't have a crystal ball, and we can't make 100% accurate predictions. But I when I speak to my clients, I always kind of put myself in the situation. I talk to them about what my situation is. My mortgage comes out in 2024. That's when I come out of my fixed rate mortgage. I'm considering, as a mortgage broker now, do I eat an early repayment charge now to lock myself in for a 5-year fix to ride this wave out? I can't accurately say 100% that the interest rates are going to go up and go up and go up, and then in 2 years' time you're going to be at the worst point. But that's what my prediction is. For me, it's just that uncertainty piece, because I know cost of living has gone up. I know I keep harping on about that, but you've got cost of living crisis coming in. Everything's more expensive. So I've got a budget to get through my month like every other human being does. Do I lock in my costs for the next 5 years so I know I can afford it, or do I take the gamble? Yeah. And I think, I'm going to hope that in 2 years' time, we do start to see interest rate decreases, so I can ride that out. And it is, for me, and that, again, when I speak to the clients, it's like, I'd rather know what I'm going to be paying for the next 5 years, as solid as I can be, and then in 5 years' time, hopefully we'll be in a better position. Can I gamble it in 2 years' time with everything the way it's going at the moment? No, I can't. I can't take that gamble. It's just too much of a risk.
I mean, rates are, they are predicted to kind of go up, but then, as you said before, come back down again. Potentially at the moment, rates are about 1.75. We're going to see those, I think, definitely creep up to, 2%, if not just over 2% before the end of the year. There's potential talk about rates going up as kind of, as high as kind of 4.25, 4.5%, which means that for mortgage rates, we could be looking as high as, 5.5 to kind of just over 6%. So those are really, really really big jumps up and you put it in some sort of context, excuse the paper shuffling, if we took, say, for example, just examples, we have to back this up, not back this up, but have to make sure we say all the figure work, is the fact that based on a 5-year fixed rate, if someone came to us with a £225,000 mortgage, a £300,000 house on a 25-year fixed term, on a 25-year term for a 5-year fixed, rates as of today are going to be around about £1,126 a month. When we look at those rates when they hit their peak, say for example they were to peak at, say for example, 5.5 to 6.25, your mortgage would jump up to some region of around about £250 a month more, so between £1,380 and £1,480 a month. So it's going to jump up a kind of £255 a month, which is
another squeeze.
And the difference is the fact that for yourself, if you're in your last year of your early repayment charge, that can be, say, for example, as much as 1% normally for majority lenders. So that means, all right, you might have to pay a fine of, £2,250 out, but potentially, you could end up saving yourself maybe £250 a month. But we don't know what that's going to be. Hopefully it isn't that extreme.
But you then take that
risk.
No, but you take your numbers you just gone about, and let's talk about when we were doing mortgages back in December.
Yeah.
What were the rates that we were giving out to clients then? We're like 1%, 1 point.
Yeah, under 1% at one point.
It was so, and now you're doing kind of prime mortgages with high street lenders, source one through our panel, and they're like 3.2, 3.5. So this isn't some sort of like Armageddon type story. Oh my God, panic. This is evidence. We've seen this. We've seen a huge uplift in these interest rates over the last few months. Taken to that effect, the lenders aren't stupid. They know exactly that the rates are going to go up. They predict it. I think the next meeting, the MCP is on the 15th of September. But I've already got emails coming through from the lenders, and they're already saying, we're changing our products. We're going up by 0.3. One of the major lenders came through today, put up all our products by 0.3%. So they're already predicting that it's going to go up by a quarter or 0.3 in a couple of days' time.
But that's the other thing to kind of speak about is the fact as well, like lenders' margins have increased. So back when rates were like 0.1, 0.25%, we could get rates around about, say, like just under the 1% mark, which means the lenders are working on a markup about 0.8, 0.9%. We're now seeing lenders' markup of being, in excess of almost 2%. So, and I think the reason for that is because even though interest rates are going up, what we're finding is the fact that, the amount of transactions are happening haven't really dropped away. So people were still doing, tons and tons of mortgages. Lenders are so busy. So, for example, one of the major lenders like as an example, Nationwide, we used to be able to get through with them in a roundabout. It's not pulling them out. I'll use another one in a second. But Nationwide, for example, there used to be, if I ignore lenders and just say our own normal, time it takes to get to mortgage used to be, before COVID, I reckon 7 to 10 days for a mortgage offer. So it was nice, quick and easy. If there are any issues, you could fix it, make placement with another lender, whatever else it is. Now, some of the mainstream lenders, some of the high street banks, for us to get from start to finish, are taking somewhere between a month to kind of 6 weeks, which is horrific. And the reason for that is they're just so busy because of volume of transactions.
17-day working turnaround for new submitted documents to a case.
For an initial, that's not the worst I've seen. I've seen as high as 25 days with one particular lender.
Yeah, is that right?
So they've literally over a month. Well, nearly 5.5, 6 weeks to even look at the first look at a case.
And that would be one of my top tips that you would give out to your, on some of the social media that you do, is that if your broker asks you for information, give it to them clean and concise. Don't send a picture on the beer mat. If we set up a load of document and it goes to the lender and the lender is not happy with it, we go back into another holding days, and it'll prolong these things out because they are just so busy. They're not being mean. They're not trying to be, punish you for it. They're just so busy.
So my position was the fact that with we are getting contacted, all the time to try and see whether people are better off kind of jumping out now or holding on, that sort of stuff. It's going to add even more pressure potentially, clog things up even more potentially.
I mean, I would definitely say anyone, like, if I'm looking at it as a mortgage broker and I'm looking at my own mortgage and the options around that now, everyone that's got a mortgage that's coming out of it was still in a fixed term for the next 18 months or less, you need to be talking to us like yesterday, because there's so much changing, there's so much moving, so much happening. The interest rates are in such a flux at the moment that you need to prepare for what's just about to happen. As I say, it's not Armageddon, but you do need to be prepared and kind of look at your options moving forward.
I mean, most lenders' offers if it takes us kind of a month to get an offer, for example, between 2 weeks and 6 weeks to get an offer, most of those lenders' offers are going to last for kind of 6 months or so. So potentially, we can look to work on mortgages that maybe are 7.5 months away, or whatever else it is. Potentially replace a lender that is a bit slower. So sometimes we can get those offers extended. So we are doing, I'd say, more remortgages now for people that end in 6 to 7 months than what we've ever had done before. Normally, we'd wait until they were, I don't know, 2 or 3 months, beforehand. We'd have a little check on what their current lender's doing. We'd do the PT, but maybe do a product transfer. Look at the difference between a product transfer and a remortgage. Now it's a case of we can do a mortgage now, and that can last you for 6 months, or we can sit here and wait for another 3 months, wait to see what the lender's product transfer rates come out. Product transfer is when you stay with the lender you're currently with. We can wait till those product transfer out, and then we can compare the two. The issue we've got now is everyone's fairly certain that, if we wait for a product transfer rates for another 3 more months, they're going to be higher than what we could get people now as a remortgage.
Well, I just have a question on your mortgage, your own personal mortgage. Would you want today's rate, or would you want the unknown rate that you're going to get in December? Which one are you going to choose?
Much like a plumber has leaky taps, we actually missed the date of our mortgage, and we want our SVR for 2 months before.
Good work as a mortgage broker.
I'm not the best person to ask on that because we completely nose us up. But yes, I would definitely, in today's market, you'd want to try and hold stuff sooner rather than later.
Absolutely, and we're doing a lot of that for clients at the moment. So
let me ask another question, because the other thing that's kind of we're talking about a lot of brokers as well is going to be, I'd say, the amount, the lender's margin. So we are talking about rates going up. We're talking about maybe going up for kind of, a couple of years, maybe in a couple of years' time, rates are going to be higher. So we estimate that the mortgage rates could be this much higher. But something that's kind of come around a lot as well is the fact that lenders' margin. So at the moment, lenders are really, really busy. Mm-hmm. We anticipate that as time goes on, those lenders are not going to be as busy, because we believe that property transactions are really kind of slowing down a little bit. I mean, August is a bit of an off month, so you can't really count August, but we're not probably doing as many new transactions as what we were 6 months or a year ago. Mm-hmm. So, once this kind of big bulk of kind of remortgages are basically done for people looking to look whether they're staying or going and coming out there with repayment charges, there is a school of thought that says that potentially lenders' margins at the moment are higher than what they've ever been. Now they're working at kind of, difference between 1.5, between 1.75 and 3.2, 3.5%. They're working anything up to 1.75% margin, whereas before they're only working on, under, say, 0.8, 0.9% in terms of a margin they were getting. So there is something to be said that, all the lenders are taking on much more staff now. They're busier than what they've ever been. What happens when the mortgage business starts to slow down? And it is still the lenders will kind of fight against each other to get that business like they were before. Now, at the moment, with lenders being so busy, it seems to be a race away from the business as such. So, it'll be that everyone else moves up, the lenders are the cheapest. They go, oh, we don't want to be the cheapest anymore. Oh, well, we're going to get too much business. They raise it right up. So it's kind of almost a race up at the moment. But on the flip side, what happens then in kind of 18 months, 2 years' time, when, yes, rates have gone up, but there is an argument, you said, that could be counterbalanced by saying that lenders' margins are going to kind of come down.
So, in my opinion, it's going to come down to really why that margin has been created. We have that fact that, a lender, they have a great rate, they get that full of mortgages. We have that conveyor belt system where they get, they're busy, they remove their great headline rates, and the next great lender moves into place underneath them. And our job, obviously, as a broker is to give the person the best product on the market at date of application. Is that why they're doing that? Is that, are they putting that much margin in there to say, we're all really busy, we don't want it? Or are they predicting that things are going to get really tough and all of a sudden things are going to start going the way of the pair for people that are in mortgages? Are they predicting that they're going to have a glut of problems down the line?
So, for example, they need, the amount of what you kind of saying is a matter of potentially repossessions going to have, for example.
And
I'm saying that is that.
That's the scariest word in the world, isn't it, when you're a homeowner? But are they predicting that people are too close to the bone? And as the cost of living crisis bites in, that people are not going to be able to service their mortgage. So they're going to be stuck in this kind of quandary of, okay, do we have this absolute glut of repossessions and potentially flatline the market? Or do we just eat it as a government subsidized thing and eat sort of like 6 months worth of mortgage arrears and then service that debt later on down the line. So they need that money to kind of keep themselves not literally buoyant. I'm not saying the banks are going to collapse, but they need that money there as a case of we're creating this margin because we know times are going to get difficult, even for us as a lender. So we're going to put this margin there. In my mind, that's what I see. I see there could be two. Yes, we want to pull people away from applying with us at the moment because we're a bit more expensive than XYZ, but also on the back end, yeah, we just need to create a little buffer zone because things are going to get tough for the whole country.
I mean, I think banks always have an element of that anyway. But I do think that banks do have a kind of a seesaw between service levels and price.
Oh, definitely.
And a lot of the banks will have taken on a lot more staff to better cope with the increase in demand. A lot more underwriters, a lot more everything else. Working from home has meant they've had maybe slightly more staff because maybe they're not quite, maybe not quite sufficient as what they were working in offices. Maybe they've just got now a lot more work to do. But principally, we are seeing, as I say, the service levels are absolutely awful, which is the reason. Well, I personally think the reason why the margins are higher at the moment. There's better service there. But there is a school of thought to be said that the yes rates are going to go up, but potentially lenders' margins are going to come down. So hopefully they should kind of equal each other out. Personally, I don't think that. Personally, I think that when it's really good again and rates are starting to drop again, then lenders will start to kind of battle for business potentially. Yeah. And I think that maybe banks do have temporary staff. Maybe they can kind of get through that bit. Certainly, I think we're a lot more geared up for kind of tougher times than what we were previously. With now all banks being so heavily regulated and having to make sure they do their own affordability checks, even though some of those have been removed and kind of moved around slightly, I think we're in a much better position than what we were before. So I mean, with someone coming to you now, because we're all, even though we're under one firm, we'll all give slightly different advice. We'll have our own opinions to what makes for good and bad advice. If someone came to you now and they're in your situation similar to you're in, and they were saying, okay, so I've got 1 year left on my mortgage, should I look to kind of remortgage now? What would you tend to go on, a 2-year fixed or 5-year fixed?
So the first thing we do is, you're going to find out what the situation is and what their long-term projection is. So are
it's
they going to
be,
they're staying at home? Are they going to be, they're looking to move on? What the, age of the kids, everything. We just need to know everything. After that, if they're planning on staying in the place long-term, it's a simple question of maths. Can I save you more now than potentially what you're going to be on in the future? And I will illustrate that to the client. It may cost you £2,000 to get out your existing mortgage, but if your mortgage goes up by 0.75%, you're going to be spending XYZ more per month. And that it is just that simple. Nothing's guaranteed. I mean, tomorrow the interest rate could be, on the 15th of September, it could be lowered to 0. It won't be, but it could be.
Be nice.
Yeah, exactly. Yeah, make our jobs easier. But yeah, in the reality of it, it's just kind of it's just presenting your client with the information for them to make an educated choice. If you ask me as a consumer rather than a mortgage broker, I will pay my ERC and I will lock myself into a longer term product for about 5 years. So I know that part of my life has been budgeted for. Everything else I can argue, I can fight with, I can sort out.
The mortgage is going to be any more than X amount, and that's
I know it's there. That way, if it goes up to these ungodly rates, I'm not going to need to stress about it. I know I can ride that way for the minimum time. And if it trends up, and it doesn't seem to be trending down, a year out from there, I can start making adjustments within my own life and my own budgeting to prepare myself for that huge increase that's coming after that 5-year period.
Yeah.
At the moment, I just think it's all just too close to the bone.
Okay.
What do you think about the banks? Do you think they're going to pull away from that kind of higher rate? Because it's the question I was having with Mike the other day. What do you think about people pulling away potentially from higher loan to value mortgages, lenders wise?
I think that we're going to see. I mean, at the moment, you've got the government guarantee scheme in place. So basically, just after coronavirus, no one wanted to lend at 95% loan to value, just because, no one would lend at that at some point. So 80% loan to value, let alone 95% loan to value. So in order to kind of get the market kind of going again, the government had to bring back in again a kind of a guaranteed scheme. Now, there's kind of a bit of a cost for that, so not all lenders can do that. Not lenders want to kind of include that in their figures, but there's already a kind of a guarantee scheme in place, so that even if, say, for example, properties had to be repossessed, and that they were kind of property prices would have fallen, the banks would have suffered a loss. There's actually a government guarantee in place to stop that from happening. So that's kind of kept the market quite buoyant. And with that kind of government support, and now some of the lenders have moved away from that now because they're not so fussed about it as we are now coming out, as we were when we first come out of COVID, for example. So I can start to see there are kind of guaranteed places in scheme. And that probably leads me on to my next question, which is going to be house prices and that sort of stuff. But let's just stay where we are at the moment and talk about, the government guarantee schemes. So with government guarantee schemes in place, that should be such a scary thought for lenders that we were kind of higher loan to value lending. If that cap's kind of taken away, then I think lenders will start to panic and kind of withdraw. So it just depends on how easy and risk-free the government can make it for a lender in order to not retract those guarantees which have already put in place, basically, so lenders don't end up losing money.
I've seen affordability up there take a nosedive. So when you look at like 95% loan to value mortgages, they where before, back again December, sort of like late last year, you could get more money. Now they're really, really stingy up that end of the market.
Kind of 4.25, whereas before it was 4.5, 4.75. So we can see that higher loan to value lending is always going to be slightly riskier for lenders. There's going to be more risk involved with clients that have an entry level deposit of 5% rather than those over 25%. It is going to be more risky for lenders, and they're going to make kind of more adjustments. But moving on from that, though, then we've got the other end of the market, kind of higher incomes and that sort of stuff, whereby they're now offering. We've got 2-3 lenders now that are offering much more than what they ever would. I mean, before we were looking at kind of mortgages that were 5 times income going back a year ago, where that was absolutely deemed as being a year ago it's deemed as being the pinnacle of lending. Now we're starting to see 3, 4, 5 lenders starting to kind of go up to the kind of 5.5 times. We've heard like Echoes, but they're only Echoes. They have very often like 6 times income, but that's only really 1 or 2 lenders. And
I think I only know one.
Slightly unicorny there. And they're kind of very rare to actually get those, but potentially
the list of criteria includes some very unique things. But yeah,
exactly. But we are seeing more lenders, more mainstream lenders as well, which are offering 5.5 times income. So even in these tougher times now, they're still not withdrawn that. We had new lenders come on. We had a new lender this week that came on not only for new purchase, which is what the main scheme was with Nationwide, which is the Helping Hand, which is 5.5 times. We've now seen Accord, for example, which is part of Yorkshire Build. So they've come on and said, okay, not only for first-time buyers, but actually offer it for home movers and this sort of stuff as well. So we are starting to see, I think you'll find lenders with bigger books of kind of more reserved people, and now maybe they can go over and above with. I think one of the things that we can be certain of is potentially, I think we're doing probably a lot more debt consolidation. People are going to want to, as part of their mortgage now, start to kind of reduce their monthly outgoings. So if it means that, for example, they do have credit card debt they're servicing, or they do have loans which are a little way away from being paid off, sometimes clients are just going to want to have the lower monthly payment. Debt consolidation is not right for everybody, and it means that a whole myriad of kind of knock-on effects basically happen, such as reducing loan to value, such as paying much more interest. So you've got a low monthly payment now, much more interest over that term. But for some people, that might be the answer to kind of see them through the next little while, potentially. But so I think we're going to see a lot of debt consolidation cases start to come through. I believe lenders are going to be probably much harsher on that. We're going to start to see some lenders kind of move away a little bit, or impose slightly harsher sanctions on kind of people that want to kind of debt consolidate, especially maybe those that have done it, previously as well. So debt consolidation is not a life, it's not a lifetime. It shouldn't be deemed as being a lifestyle. Sorry, is what I meant to say.
Yeah, I think it's just we're going to see some more debt coming up. Cash flow is going to be problematic. Explaining to people that they're going to be paying more for their loan over the longer period of time. Is going to fall onto deaf ears. We'll go through the pro formas.
It won't matter.
We'll go through the pro formas. We'll talk to you. We'll explain it to you. We're going to let you know exactly what this thing is going to cost you long term. But a lot of people, I think, are almost going to be forced into it.
They'd rather have that. They'd rather have the safety of knowing that they've got the low monthly payment potentially. But even if it doesn't cost a bit more in long term, it's a later on problem. We can kick the can down the road a bit and look at that at a later date. Because
people are going to, again, it goes down to that fact that people are going to be squeezed. And I think it's important we also talk to people and just kind of give them very frilly, but kind of like, this needs to be the last time we do this. You need to calm down now, because, there may not be, the options are getting more and more limited as things go on.
Yeah. Something road rage outside the office.
Is it proper? Okay. So yeah,
just a normal morning commute for you.
Exactly. Yeah. I can do that.
In the mortgage monster mobile.
Exactly. I do. So let me redo that because obviously that would probably kill that. So yeah, debt consolidation, already seeing more of them, number one. And I think, I think we're already seeing hang on, let me do that. Yeah, debt comp, we're already seeing more of them. I've done more in the last 2 months than I've done probably in the previous 12.
Yeah.
People are really, obviously, because they feel that pinch, it's managing the cash flow. And
pre-planning.
Yeah, it's pre-planning. And I think quite literally everyone that's got a house at the moment needs to be planning and sorting themselves out, making sure that they're financially on solid ground. And I say that as a mortgage broker, but go and speak to your mortgage broker, go and speak to someone.
Not just, don't come to us.
Go to anyone, just go and let them run through the numbers with you and just make sure that you're prepared. Failure to prepare, you can prepare to fail. You're going to get kicked about. It's an easy conversation. It's a 30-minute conversation for someone with a calculator that knows what he's doing to run through your finances and say, yeah, here we are.
Without the thing, they should be able to run you through as many scenarios as you want to be run through. If you want to go through 27 different scenarios, get your in scenario, you really want someone's going to take the time to kind of do that with you and make sure that you're comfortable in your decision to make for the next 2 or 5 years, basically.
Yeah.
10 years.
I had a client, I can't obviously say their name, and they're probably watching this podcast, so they're going to realize who it is. I had a client that was in the financial situation was so, and I mean, we're talking razor close to the bone, that we needed to get something done for them now. And I think if we would have waited longer with their debt comp problems, they would have started to, the debt issues would have started to default. The defaults would have then moved them away from the prime lender, the top lenders, which means we would have gone challenger bank to subprime, which would have broken affordability, which would have meant they would have jumped onto SVR, and all of a sudden
we killed them as well anyway.
And
especially rates going up,
and it compounds. So now, I've defaulted because I couldn't afford it. Now my mortgage company is going to give me an SVR. I can't remortgage to come off of that.
Is when you go up
standard variable rate,
and the payment jumps up.
They're going to jump on the standard variable rate. So when I jump up standard variable rate, my mortgage is going to go up by 200 quid. I've got these debt problems that are already collating and causing me a huge issue here. And the next thing down the road is, arrangements to pay. And it's, no, I'm not going to say bankruptcy because that's terrible. But now you've got a huge problem, and we needed to do that for them now and kind of give them you cannot get back into the situation again. Let's get this sorted out now for you. And their mortgage doesn't even complete until the end of the year, but we've gotten locked down on the product now. So they've got this kind of, obviously, service your debt, don't miss any payments, but you've got that 5-month period where, okay, we know we're going to be here, and then after that we're going to be secure for 5 years, and we know that's what we're going to be.
I mean, we have had in terms of securing your debt, not missing payments, and that sort of stuff. Have you seen the campaign, which is run by basically Don't Pay, which says the beginning of October, they've recommended that everybody get together, trying to get 1 million signatures together, so that people all cancel the direct debits on that day.
Okay, I haven't seen that.
So it's a new thing they're going to try. No, it's a new movement of people they're trying to get to do, and they're trying to get everybody, as I say, to sign up to basically. As I say, they're trying to be able to hand out flyers at football games, this, that, and the other. So, my one bit of advice, and I'll talk about it in a second, is please, if you can, don't miss any payments for utilities. But let's talk about doing it so that hopefully what will happen is the fact that, we can all vote by, it'll be like the poll tax when that was all done in whatever it is, like late 80s and that sort of stuff. We move our feet. We show the energy companies that, we're basically boss, so therefore we shouldn't be paying any of our bills, and no one's going to pay or a million people aren't going to pay their bill on the first of the time. They're going to cancel their kind of direct debits. And I see what possibly good that can do, but surely if everyone turned the lights on and turned it back on again for 2 days, that's going to help be much better to show energy companies that we mean business rather than cancelling direct debits.
I generally think you're being polite. I don't see that being I don't see that doing any good whatsoever. That as well as I do, a bad credit file and you're getting punished for it. You may think you're being smart because you haven't paid. I'm not paying the electricity company, blah 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 blah. So you're going to save your £200 a month electricity bill for 3 months before they take you to court, and then you're going to pay £500 a month on your mortgage for the next 5 years. So you've saved 600 and you've spent yourself 30 because you. Come on, stop. Be realistic. The most important, well, it's not the most important thing you got, but one of the most important things that we do in this job is
Educate people on credit files.
Yeah. And I mean, I was saying this to Victoria, you know, I want to go and sit with my kids at their school and actually physically have a chat with them, like an assembly type thing, and be like, you know, things you're not taught. You're taught about history, you're taught about math, taught about English, but you're not taught about your credit and how that can affect you in the long term.
Yeah.
And, you know, if you've got something, pay it. Don't dispute it. Don't get on your high horse. Physically had a client, you know, the client didn't want to pay a bill.
You can always pay it. They will refund it to you afterwards if you're in the right.
And this is my point. I had a client, as you know, didn't want to pay a bill, stood on his hind legs on it because he didn't want to pay £100 bill, defaulted on it for 18 months, wrecked his credit file. I don't want to pay it because I don't need to pay it. Okay, fine, great, good for you. By the way, your mortgage is now going to cost you £390 a month more than it would have done if I could have got you on the phone. So your point that you tried to prove, your £100, has cost you £390 a month for the next 5 years. Who won that argument? You know, you're going to lose. Don't do that. Don't. If you've got debts, pay them. Service your debts. Don't ever.
If you can, obviously, you know, if you are experiencing difficulty, you know, reach out to your energy company. We're going to start to see, I believe, you know, a bit more support for the incoming, you know, for what's happening come kind of October time with energy price caps and that sort of stuff. So I think there will be a bit more support there and definitely a bit more understanding. So everyone is kind of understands what's going to happen. I mean, that might be due to lack of supply as well, is a little bit. I mean, August is a predominantly a nightmare time. But then again, you do get conflicting reports. We've had like Rightmove come out and said that, well, the house offer prices have dropped by as much as kind of £5,000, where people aren't taking maybe such higher offers as what they were before. Yet we do, as I say, see the ONS data, but some of that data is maybe going back 2 months ago, 3 months ago to kind of June, July we're working off now. So it takes a long time to kind of collate it all. But I mean, we've seen kind of lots of things that should wobble house price before. So, for example, it was going to be when they brought in the stamp duty increase. Oh my God, no one's going to buy a buy-to-let property. That's all going to die away. And we've got a graph on the board over there at some point of showing, you know, when house prices went up and when they went down and how much house prices were. And Chris is kind of collecting all the information for us. And we do have seen big kind of drops and that sort of stuff. And you know, probably the most major drop we've seen has been was in 2008 when house prices dropped by, I think it was about 12%. For us to have an absolute housing price crash with Armageddon and house prices average be kind of 12% less. The UK, I think, is pretty released kind of price drops. I mean, if you know, looking back other areas in Europe, for example, Spain, oh my gosh, like with the oversupply property there, house prices dropped by as much as 50 to 60% as an example. You know, so we have seen kind of, you know, price crashes here in the UK before, but they have been a bit, but they've not been absolutely monstrous, you know, as much as kind of 12%. But more recent that we've seen other bits have happened. So like, for example, when they brought out the second person stamp duty, house prices did kind of stagnate for a little while. Everyone went, okay, let's readjust, look what we can do. And we did fall off a cliff for kind of 6 to 9 months while we were waiting for kind of buy-to-let landlords to kind of go, I've got to pay another now 9, 10, 15 grand for a property in stamp duty I didn't want to have to pay before. I think that slowed down house, you know, I think that kind of made house price stagnate for a little while. Brexit, that was the next thing that was going to kind of make house prices absolutely kind of, you know, drop through the floor. And we were going to see, you know, massive reductions because all this stuff was going to happen. We didn't see any.
No.
Then it was coronavirus. That's absolutely terrible, going to make house prices crash. No one was able to work and that sort of stuff. And yes, there was a period where they did drop and people were kind of desperate. People, you know, some of those lucky enough to kind of buy those properties from people that were maybe in harder situations or believed that the outcomes would be more bleak than what it was. But since then, house prices have gone up by
just keep
15, 18%.
Yeah, I think that whole thing of, oh, it's going to crash, it's going to crash, it's going to crash is, you know, the boy who cried wolf, isn't it? It just, everyone keeps talking about it. Again, it comes down to that thing, we don't have crystal ball. Can't guarantee it, but I just don't see it. I just think the demand is so high, especially down here in the southeast. I mean, the demand is absolutely so high that they just keep going up. And the other thing is, and I had a great conversation with a client that came in with me, and he wanted to go from being in rental and he wanted to move from rental into buying a house. And we had a chat and I was talking about, is it a good time to buy? I said, it's not as good as it would have been like, you know, a year ago, but you're still in a great place. And then we started looking about how much money he was paying on rent. He was paying about £1,300 a month on rent. Mm-hmm. And he said, would it be better to kind of ride this out in renting and then buy a house in sort of like 3-4 years time when this situation should equal itself out? We'll do the math. Okay. So you buy a house and you might lose, say, let's say you lose 10%. You buy a £300,000 house and you lose 10% of it. So you've lost 30k in equity, and you still live there. How much did you pay in rent for that 4-year period, for that 48 months of paying it at $1,300 a month? How much did you lose in that time? Did you just give away? Well, when you realise that you've given away the best part of £55,000, you're in a better position, and you're not going to see a huge 10% drop off. And the last thing is if it's yours and you're living in it, it will always go up over a
long enough period
of time. So if you're living there, who cares?
That's the thing, is the fact it is all relative as well now. So it's going to cost you another £20,000, well, £50,000 to jump from your house now to for example, from your flat to your 2-bedroom flat, from your 3-bedroom home. We can still see it being about that, with house price go up a bit or go down a bit. So it is quite relative.
It's relative to you, your situation, the person talking to. I mean, if you're living with mum and dad, maybe a different situation. But if you're already renting, you're already getting skinned alive by your landlord, then let's talk about putting that money into something that's longer term investment. Because as you say, well, the one thing we are confident on is that given a long enough period of time, your house will increase in equity.
Well, we've seen that from previous past results of what's happened. We've seen it from the fact that there isn't enough supply for property. There's always going to be more people that want to buy it than what there is that want to sell it. There's going to be a growing population. House builders can't build homes quick enough. So all sorts of things is building up to more and more demand. Yeah. Whether it gets to the point where that demand is then, as many see it now as being out of reach for kind of everyday people, what we might see over time going on is the fact that we do move more towards maybe, more properties being let out, more people, just buying houses. It is that way, but we want to help out everyone that we can. If we can get you more, if it means that it's not the home that you want right now, and if it means that you can't, when mum and dad forget about their very first time they had a 3-bedroom terraced house, for example, for first time buyers now trying to get into a 3-bedroom terraced house, that might not work. Sometimes might need to have 1-bedroom or 2-bedroom flat to build enough equity, meet a partner, both work towards then having that family house in time. So about down south, more Midlands, more north, and this sort of stuff, it can be a little bit easier. There isn't such a massive gap between people's wages and the sort of house that they can buy. And whenever we do a post of any kind, it talks about different areas of property. We always get everyone up north, everyone down south, and that's, I can never afford to buy a home. People in some areas north going, it's so easy, I can buy 3, and it's kind of you're always going to get this massive divide for people.
You are right, though. A lot of people, you talk to them, and they have to realise that you want to have the 5-bedroom detached mansion with the jacuzzi and the 3-car garage, but it's going to take you time to get there, and you need to work on that. Sometimes you need to take a few hops along the way. You need the studio flat. Yeah, of course. You need the studio flat. You need the 2-bedroom apartment. You then get your 3-bedroom terrace, and then finally you end up in your 4-bedroom detached. You get there in the end. You don't just kind of swing for the fences and try and get it on day one. And it's people that are trying to do that are going to end up in the most trouble.
Well, it's we've really we've all seen stuff, but I think house, again, of people kind of sometimes go, I think house price can drop, it's going to be all okay, and we see them then again, 2 years later, and it hasn't gone the way which they expected, and maybe they do have to take less of something now, but any step someone takes is potentially going to be better than giving all of your money to someone else and owning nothing at the end of 25 or 30 years.
Absolutely.
So, and that's why we're so passionate about home ownership, is the fact that, if by the time everyone decides they've got their own home, they have to worry about rent, we'll do whatever we can to help people.
Oh, absolutely. And it is just making sure that the shoe fits the client, isn't it? It's just making sure that the situation is right for the client at the time of application. So
we've been chatting for a little while now. I know there's loads more that we could talk about. We could talk for hours and hours and hours. But we need to start to get it up, to get it kind of tied up, to get it in some sort of reasonable shape. To just kind of starting to kind of put it all together. Just to remind people that we're here for you, whatever else it is. Any problems, any questions, pick up the telephone. Please don't hide your head in the sand. Let's run through as many scenarios as you want to. And if you want us to kind of look at, not just us, but speak to any broker. I mean, that would be nice, but it's not necessary. Speak to absolutely anyone and just see whether or not, I'd rather you not have sleepless nights worrying about stuff. When you come sit down, we can run through figures and we can kind of start to kind of pre-plan stuff. And we've seen people walk in here that, or when we start speaking to them, you can just tell how tense they are, because money's a scary subject, mate.
Very.
It really, really is. You see people when they come in, they're absolutely light, they're uptight or terrified, but by the time you've kind of looked at different solutions, sometimes you'll just see them absolutely relax and go, it isn't that bad. So I think sometimes the thought of it is worse than actually doing it.
Correct. I mean, the first thing is ask yourself the question, do you think you're 100% prepared for what's going to happen in the future? Once you get around that, I don't want to be rude, but pull your head out the sand. If you're putting your head in the sand and just hoping it's going to go away, it ain't. Next thing is talk to someone that really knows what they're talking about and go and explore your options. The stories.
Do you mean a different mortgage broker or us?
Yeah, well, yeah. Someone, call Mike. Call Mike and he'll be able to sort you out. No, go and speak to someone, give your broker a call and get them to explore the options with you. And it's not going to be as bad as you think it is. Even if you're in a really tough situation, we can start looking at ways to dig you out of it long term.
Well, there's little things to say. There is things like, extending the term of the mortgage. Would be things like, for example, looking at maybe consolidating some debts. It could be maybe, looking at a different product, maybe part of that being on interest only. It could be, there are lots of other ramifications we have to look at when we talk about those different things. Not one size fits all, but normally there's quite a number of options that we could potentially look at for. We have lots of people that come, for example, to the end of their term, for example, that we can maybe look at tools of equity release about, and that's kind of free up any form of mortgage payment every single month. So that, we understand that mortgages and money, they are scary subjects. They cause people to tense up, to not sleep at night, to not be very well.
Not open the letters, put your head in the sand because it's the horror stories down the road. And that is the worst case. Go and speak to someone. Go and speak to a broker, your broker, us. Go and speak to someone that really can look at those options and prepare you for what's about to happen. It's not a horror story. It's not Armageddon. There's no comet coming. But we can look at it and make sure that you are as prepared as you can be for the future.
The other thing to bear in mind is if it isn't bad at all, if it's all okay, if the price cap doesn't come in and people are prepared, they've brought their mortgage payments down or whatever else it is, they're fully prepared for it to happen. And if for some reason it doesn't happen, maybe energy prices drop right down again, maybe inflation drops right down again, maybe they don't have to increase rates, we can still talk about overpayments. So you've got an excess of money left over if we prepared you for it and you've been too overprepared. You can always overpay again a little bit if you choose to and take you back to your original situation. So there's nothing wrong with being maybe too prepared and too over top and then kind of bring it back down again by paying a bit more off the lender every single month. If you have more money and it's less extreme than what we think you might be.
Absolutely prepared, but no one wants to have that uncertainty, like literally no one. So if you are fearful of the future and you're uncertain what's going to happen, just lock everything in now. And if the situation looks brighter on the other side, then as you say, we can talk to you and say, great, I tell you what, we've prepared you so well for this situation. Now we're going to shorten your mortgage because you're going to make overpayments for the next XYZ months.
Yeah.
Perfect. So it's a win-win-win for all.
So Grant, thank you very much for today. I'm afraid that's all we've got time for. Thank you very much for tuning in and being part of what it is that we do. If you love the podcast, please don't forget to follow us and leave a review. It really helps us get up those rankings. For anything that you've got, just drop us an email or contact us in one of the many ways that you can. Otherwise, thank you very much and we'll see you soon.